Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for our Wednesday edition of Trader Talk in today's market. I'm your host, Kevin Horner, coming to you from a beautiful Denver, Colorado. Today, I am running solo with all of you. Brent Moore's out on a little PTO. So today we're going to get down to business, checking out the news of the morning. A little bit of a bounce to our open here today on the heels of some news out of the administration and our Iran conflict. So we'll cover some of that. We're going to look at all the major details, of course. You know, we're going to look at oil, and we're going to take a look at precious metals, all the fun stuff with you all today. So lots of charts to hit. I'm looking forward to it. Thanks for being here, everybody. We are joined by Barb Armstrong in the chat, so please take a minute and say hey to Barb. She's going to take care of comments and questions that I'm unable to get to for you. But of course, I'm going to keep an eye on things there. I want to hear from you all as we work our way through this discussion, and I'm happy to bring your comments and questions into our conversation. So please feel free to post in there for the duration of our show. We're going to go about 45 minutes in total. Now, please, if you're not already doing so, follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS, without a doubt. X, the best place that you can engage with us when we are not offering you classes here on the channel. So meet us there on X. Let us know what you think about those posts. Ask your questions. We try to reply where we have the opportunity, of course. So love to hear from you there. And then last note, you always want to make sure you're subscribed to the channel we call Trader Talks, of course. But if this class in particular is helpful for you, hit that thumbs up button down below for me. Once we get these reviewed and archived, we can get a little bit of a lift and benefit from those thumbs up. That helps us out with the algorithm here on YouTube. So with that, let's get to our disclosures and we'll jump into things. So first and foremost, please remember that today's conversation is exclusively for your information and your education. We're not here to make recommendations nor any endorsement for a specific approach to trading this market, but we are here to kind of review and utilize technical analysis. We'll offer up concepts and strategies traders may choose to employ, but when you're thinking about technicals, please do not base your decisions exclusively off what you see in the way of technical analysis. We think a balanced approach that allows you to use the technicals to answer or make some of these decisions is helpful, just not the entirety of it. So, beyond that, we want to remind you, of course, that we work in our paper money version of Think or Swim. That's a little bit different. Some of the scan access, for example, does not carry from live money to paper money, so be aware of that. Let's also check out our agenda, which is pretty standardized for this class. We will review the broadest indices, so we're going to absolutely look at the S&P, the NASDAQ 100, the Russell 2000. We'll expand, make sure we get into semiconductors and some of those other industry groups as well, plus our sectors and, of course, stocks in the news today. Now, before we run to the charts, I'll just remind you of our upcoming workshops where we're going to be. We are in Denver this weekend. Lucky for me, I don't have to utilize an airplane this week, which is wonderful. If you have the opportunity to be at the Gaylord Rockies, come by and say hi, shake a hand, take a picture, whatever you want to do. I love seeing you all at the events. We're going to be in Dallas for the advanced options, also at the Gaylord there in mid-April. I will not be at that one, unfortunately, but you can plan to see me in Boston on the weekend of April 17th and 18th. Believe it or not, we are there the same weekend as the Boston Marathon. So that ought to be entertaining and fun from a travel standpoint. Okay, with that, let's get to the charts, everybody. So here's a look at the S&P 500. We're up 65 points off the open, 1%. You know, before we do that, I'm going to bring in my chart that I have been relying on pretty frequently here over the last 3+ weeks. And I'm utilizing futures symbols on this, everybody. So please remember, we're using futures merely as a means of evaluating price levels, not from a trade standpoint. So when we look at this, the key factors we're watching are the price action in oil basically invert inverted wise mirroring what we're getting in the S&P. So over here on the far left is my futures for the S&P 500, and you'll notice this little range I've drawn in on the S&P is akin to the range we've got on oil. So we broke this up, this rising wedge formation that basically rallied into 93 bucks a barrel yesterday. When we broke down, it happened in after hours, and so we made this break in the after hours, and then oil has now since gone sideways. But the question is, can we get the oil under the range we've just created? So oil under 86 looks like the kind of scenario where we can witness the S&P getting a little bit more lift here. I think this is helpful for us to be evaluating it. You know, some of you might not want the VIX in the middle of it. You may just want to look at crude and the S&P futures side by side. That would be fine as well. But ultimately, there is a clear inverse relationship here between the crude light barrel and the movement in the S&P. So that should give us a little bit clarity here, regardless of the lack of clarity we continue to get in the way of discussions. It seems like every headline that says, hey, we're making progress is then met with a headline that denies said progress. And that's a little difficult for the market to really understand, obviously, but that's where we are. It is headline driven. And what that means to me is, while headline driven doesn't imply that we can't rely on the price action, what it does let us know is that we might have more volatility than with which we have comfort. And so if that's the case, everybody, if you are finding these swings to be more aggressive than you can maintain, that's okay. Keep your position size smaller, utilize 25% position, 50% position size. You may find yourself a little bit more comfortable, and that's okay. No trouble with that at all. Now, the challenge for you bulls out there at this time is going to be to look at all of this green and say, hey, this is perfect. Everything's going to go right back to the way it was, right? A real comfortable market, a lower VIX, etc. Try not to put yourself head over skis in this market. This is not a market that is conducive to the trader wanting to be aggressive. At least I don't feel like that's what we're getting here on the bull side, at least not yet. And I have to remind us that when we go through these periods of weakness, again, it is so easy for the bullish trader, because it's human nature. We want to believe in the market. It's really easy for the bullish trader to take what we're getting in the short run as the most important aspect. And it is important, no doubt, but we need to have the plan and understand what we're witnessing here in the way of the trend. And the truth is, the most important short-term situation right now is the very obvious weakness below the 20-day moving average. I'll call you back to the very brief window when we were above it for 2 days, and since we have been below it aggressively. So every rally into the 20-day has been sold. Most recently, the rallies have not even come to the 20, as you can see. So yeah, we have every chance for this to continue. You know, we love this green candle off the open. We are above the high of our lowest traded level day on the SPX, that being March 20th's high. And that'll look great if that candle stays green. But everybody, be thoughtful about it. What if that candle is the most gorgeous, beautiful, big green candle, looks kind of like this one, and it finishes today somewhere in the neighborhood of 6,700? We would have an incredible rally day, right? It would feel fantastic. And yet it would not change the current short-term downtrend. And so if you're a trader wanting to be bullish, set your targets appropriately based on current trend. I'm not telling you we can't go higher than the 20-day, but I am suggesting that a rally into the 20-day leaves us at an area where bears might start to take over. And what we should be saying is, really, at the 20-day, we're more likely to find an ample supply of volume and shares ready to be sold. So if you're rallying into the 20-day and we start to see that become a pause zone, that would be kind of expected, right, from a technical standpoint. So as Richard's been reminding us, the trend is your friend. Let's wait until we get some semblance of confirmation, which would be trading above the 20-day, maybe more than 2 days, right? If we can get that from this market, from the S&P in particular, then we've got a chance to be witnessing a bigger bounce. But let's not put ourselves head over skis. Let's trade for the trend we have. And it looks like if we're going to get a bounce, the first bounce we need is a relief bounce that potentially could become more, right? So that's what we're looking at in the SPX. I'll put my major moving averages back up there. As you can see, we are right into the 200-day. Last thing I wanted to look at was the 15-minute bars. And this is kind of the nice view of things here. I'm going to draw that downtrend line. So we're above that. We like that, right? All of yesterday's action, Monday and Tuesday action, kind of looking like a standard consolidation, almost to the point where, you know, you might look at this and say, oh, there's kind of a little bit of a left shoulder and maybe a little bit of a right shoulder and the head down here. And if we are loving that, then we got to trade above the level, the highest we've been, which is around 6650. So if anything else, everybody, if we take the S&P through a zone of 6650, then we've got bias for potential more upside. That's the key takeaway there, at least in the immediate future, as we stare at the S&P on an intraday basis. You know, Rocco, I see your note there, buddy. I just had the exact same situation happen to me here in the My Tools area up above. I had to rebuild that. I had it actually rebuilt yesterday afternoon. And granted, I don't like having to redo it. Of course, I would prefer that I didn't, but I did have to go in and update my buttons again. It took me all of about 3 to 4 minutes, but those reset, and I don't know why. I thought maybe it was tied to the recent update or upgrade we may have made last week. I don't have any confirmation of that, but I'll just say that setting those is a pain, yes, but it only took me about 3 to 4 minutes. And so I'll apologize that you have to do it at all, but I'm sure we're going to get that fixed over time here in the next few days, hopefully. Okay, let's take a look, everybody, at the NASDAQ 100. We've got a 1.25% move here on the NASDAQ initially. Let's go ahead and get that kicked on. There we go. Same chart, basically, right? We've got, we're right below the 200-day, bouncing off of our horizontal support area, trying to get the same validation. The difference, I mean, you could probably say the same thing about the 20-day with the NDX as we said about it with the S&P 500, but I also think that the 50-day has been a little bit more consistent for the NASDAQ. So you've got a couple of days here above it, couple of days above the 20, couple more above the 20. So you can see there's been a little bit more volatility, a little bit of a wider berth necessary here with regard to the NASDAQ 100. But as you see, we are coming into the 200 or kind of close to it. But look at the highs that we have made over the last week and kind of eyeball those for you as an area above which we would like to trade, because on an intra-period chart, that line will stand out a little bit more. There you go. You can see if we can get up there through this, get out of all this mess, then we've got opportunity once more. You know, we got to get through certain resistance areas to kind of lift the lid for us and give us a chance to get back in gear. But nonetheless, downtrend short term can't be ignored. The positive thing we can take from this perhaps is that this established floor that we've put in here at around 23.8 on the NDX is a level under which many traders will change their plan. And what I mean is they may not change the plan, but they'll reduce position size, right? If your NASDAQ 100 breaks below this level of support, well, once broken, support could become resistance. And so this becomes an area where traders will change their risk tolerance, lift some NDX exposure, take that out of the market, build cash, look for other opportunities, and it might force traders to take some action. But the key component here is having tested this ledge multiple times. We've got at least two now, right? The mid-November one and this one just this week or in the last week. we have confirmed it as support, if nothing else. So that tells us that a move beneath it is significant and we should take heed, right? Now, how you do that, how you manage that is entirely your discretion, of course. Some of you will say a single day close below that level is enough to kick you out of a portion of your trade. Some of you will say, I need 2 days closing below it or 3 days in a row closing below it. Whatever that is for you. As long as you've defined it and then you are using your definition to aid you in your process there, that's what you're looking for, okay? So make sure you've got a plan, so something you can refer to, really makes your decision making a lot easier. Okay, let's take a look at our small caps. Russell 2000 up 1.5%. This is precisely what I'm talking about. The Russell kind of leading things today, up the greatest percentage of the major indices, but look where we are, right back into the 20. Now, this is a prime spot for this bounce to pause. Doesn't mean it has to, but even if we are entirely bullish, it is perfectly fine to pause here. What we want to see, though, is sideways that allows us to hold a certain level, right? We want to make sure that we kind of hang in, and even if we go sideways for a day or two, we don't want to be immediately rejected and back at the 200 day. Of course, I hope that goes without saying, but the next layer of potential resistance, if we can get through the 20-day, is this horizontal ledge right about here at around 20, we'll call it 25.90 or so. So that becomes another area for pause or breather or what have you. Now I'm going to give you one more concept for concern, or not concern, excuse me, but concept for kind of trying to validate the trend we're watching here. So if, as an example, this is our very short-term low and we've bounced into an area of potential resistance, well, when would a bull lose steam, lose their confidence in this bounce? Well, let's say this candle closes like this, heck, we could even be through the 20-day at the close today. But if tomorrow we closed under the low we make today, this is the key level. And the reason is that if today is the highest level we trade to on our bounce, well, the first indication would be a trade below the low of the high day. So if today is the highest we can get, then a trade through today's low sometime tomorrow or Friday, that becomes the potential for the pullback back to the 200 day or something in that nature, right? So we have to kind of keep an eye on that. So that doesn't mean that's what's going to happen, but if we're thinking about it, kind of planning for it, then we're not ill prepared if it does go that way. Obviously, we would love it if we got through the 20 on a close today, carried the 20 tomorrow, and rallied through the red line, even into the 50-day moving average. All of that would be short-term bullish, but could still maintain the short to intermediate term downtrend we've been witnessing in small caps. Now, probably getting a little bit of lift today because we are witnessing the 10-year yield pull back a little bit. Yesterday, it spiked through that 4.4, but it finished with a close, basically the highest level that it had closed at over the last 3 days, and then it got pushed back today. So there's been a little bit of buying in U.S. Treasuries, pushing this note lower today. But we would ultimately most likely need to see the the yields push even further to the downside, maybe back to this support zone. We could get the lift in the Russell that we're hoping for. But this is absolutely pressuring the small caps. An elevated 10-year, in addition to elevated oil, inflationary in nature, difficult for your small cap companies to maintain and continue to do well. So any yield give back we can give, any throwback in the yield back to the 4.2 zone, or if we could get really happy, it would be under 4.2. Hey, that would be wonderful for your small caps. But in the meantime, elevated risk factors as it relates to the small caps. Okay. I saw the question from Stay Gold. No, we don't typically take a trade in this class, Stay Gold. I'll mention, traditionally we work through everything from the review of the broad market into our industry groups and sectors and individual positions. I do intend to hit some individual equity positions with you here on some news. But we'll talk about maybe some interesting levels, but by no means are we going to place an actual trade in this particular class. So just a heads up, I wanted to make sure I answered that for you. Okay, here's our look at semiconductors, everybody. A bit of a rising wedge into an area of potential resistance here. So semis have been obviously of the longer haul, our wonderful performer, but you'll notice, where did we get today? Right into the 50-day so far. And granted, we're still the first 30 minutes, so we've got plenty of time to resolve this bullishly, but clearly we've got a level that we've got to get through. And if we get through it on a close, traders are going to feel a lot better. And you can see why. I mean, you got a tail right here that we couldn't hold. We got a tail right here that we got through and couldn't hold. And then today we're up to that exact same level. For a lot of you, it might be a need to look at these intra-period charts, and you can see my levels are still drawn in. Let's go. There's a 15-minute. Let's go to the 1 hour. Yeah, so there you go. This is what we need to get through, right? Now, I'll admit, having broken down and risen into resistance, this is not the ideal setup. This sets up as a rejection zone, and hence the need to get through it. If we can clear it, well, then we have a chance to go right back to maybe the next level of former support, former resistance, which if I just took this line, let's see if it'll let me duplicate it. Sure enough. So something like this would be cool, right? So if we can get through I'll color this one red. If we can get through the red, well, then we have a potential opportunity to rally into the white level up above. Not to say that we, have to do it, obviously, but that's what we're hoping for. If we can get through all of this mess, then we can possibly continue a rally to the upside. But short term, that remains to be seen. So if nothing else, everybody, again, I want to get back to the same thing we kicked off with, which is we've got to take a look. We can be optimistic as much as we want, but given the nature of this market, we can't look at what's happening immediately as just, oh, everything's perfect. Everything's right back the way we want it to be. So again, discipline to your process, I believe, is going to be paramount to your opportunity for success. So stay true to yourself. Proper position sizing will absolutely help out. Okay, next up, let's hit our transports. Transports have certainly been struggling due to the increase in the barrel. Barrel prices are absolutely impacting that. Let's go here, extend my line through this week. I have a feeling that line is going to go right through these bottoms here. Sure enough. So there you go, everybody. Wonder about support. You wonder why support can hold or what have you. Always consider prior resistance becoming new support. That's what this line is. I think I've got this line. Let me see if it's on my weekly. It's not, but here's the lows, everybody. You can see I can just put a line right. Whoops, let's do a strict line right through it. So there you go. I mean, we had prior highs that were at this level. So here you go. This was resistance for us. And then you see the transports got through it to the upside, thrown back. How many times? Many of you are here a lot. I know I've got a lot of usual suspects in this class, and I love seeing those familiar avatars and names. You all have seen me mention this many, many times, right? The breakout to the upside, in this case, transports rallied 13.5%, maybe 14%, and then thrown all the way back to the breakout. That is not bearish if the breakout ledge holds. Right? So if nothing else, if you're a transports trader and you set your risk based on the ledge of support with the lows we've just made, well, then that makes sense for a lot of traders, right? Risk becomes a little bit more prevalent in the transports when we trade under the white line horizontally. And if we hold the white line horizontally and continue to move off of it as we are in the near term here, the short run, well, then that's great. You've got the continuation of the potential breakout. It's just not yet clear as to whether that's going to hold. Now, I'll admit, in the last couple of weeks, it has maintained, but everything can change pretty quickly, right? If this, I guess we would say last week's low gives us the low, so we really want to see the transports closing above about 18.2 on this index, the dollar DJT. We want to see us closing above the high of last week for the opportunity to be considered, reconnection of this uptrend, right? That's ultimately what we're looking at there. So the transports, a little bit of a bounce. Obviously, time frame matters, because when you look at it on the daily, the place we have stopped 3 days in a row is right beneath the 20-day moving average. So I think what we've learned as it relates to the transports, at least, is we got to get above that 20-day, and you could see why. I mean, if we went with exclusively 20-day, it was the 20-day on the way up, and it was support. And it was support from November 24 all the way until suddenly it wasn't here in March, and obviously we know why. But the why is less important than the price action, right? We know that it has played, obviously oil's move has played a huge impact on transports, but the fact remains, we're below the 20-day, it was support, now it's resistance. We get back above it, it can be support again. Let's see, should we look at no, let's not look at the components there just yet. I wanted to go back to, I see a lot of you mentioning what let's go back to my chart here, taking a look at everything. So we're still got them both banded, right? So paying attention here, oil's still in the range, S&P still in the range. We haven't broken the range. Yes, the VIX is up a little bit. We're at around, well, these are VIX futures, not, again, we're just using these for not a look at trading them, right? Remember, if you want to trade futures, you're welcome to do so here at Schwab. You do need to be approved to do so, review your risk disclosure statements, etc. But in terms of what we're getting from the futures, it's range bound within the most recent move, which is basically since yesterday's close in the S&P, range bound into this upper level range, having broken this downtrend situations, right? I think my line was going to draw through here. Maybe not. Let's try that one more time. There it goes. So there's the line. So you had that downtrend line break and along with your uptrend line break in oil. So again, inverse relationship between the two. But I think the thing we're waiting for, regardless, is getting out of those ranges. That'll help us out. You know what? The easiest thing to do here, everybody, is just share this grid with you. So why don't I do that? Let me go ahead here to my grid. I'm just going to click share. Now, the key when you open this, everybody, or when you add this to your own platform, is to give this a name so that it's easy for you to locate again. So when you go to setup and open shared item, I'll hit Control V and preview. As soon as I hit import, it's going to, oh, I forget. No, in this case, it's going to open this as a separate grid. Okay, so that'll be really simple. And then once it's open as a separate grid, what I would recommend is to title it, save it. So you come up to the grid, save grid as, so you can find it easily. I'll go ahead and post that into the chat here for you, everybody. Please remember that any of these scripts that we share with you these are not guaranteed for their timing and not guaranteed for accuracy. They're not a recommendation for your use. But I have been finding that one to be helpful in my day-to-day market review for the last 3+ weeks here. Okay, so we've looked at the S&P, the NASDAQ, the Russell, the yields, transports, and semis. Let's take a look at our sectors today. Today, we're getting a little bit of a breather in oil. It's been our best producer year to date. Can't say we're shocked by the breather, because if the market is turning the corner in any way, bulls feel emboldened. They're gonna look to take profits in oil with the hope and potentially belief that the oil situation is improving. Well, they are going to move money from profits in oil to areas that are beaten up, like discretionary, possibly technology. These are not returns that are, extreme here just yet today. We'll take what we can get, but in terms of leadership, yeah, pulling back in energy and getting a little pop in discretionary today. Now, let's take a look at these on the chart. So I think what we're going to see is that the energy chart is pretty significant. I mean, this thing has been explosive, and it's been riding that 20-day, my goodness, is there. That couldn't be much more stout than what we've seen on the 20-day back to the 20 ballpark has opportunity to join the trend. Now you've got horizontal support coincident with the 20-day moving average right here. So I've got that bull flag drawn in, but some traders would just draw this horizontal line coincident with the orange upward sloping 20-day. They kind of like the confluence of prices in here. This is a significant zone of support. So even if you're remaining bullish on energy broadly, this becomes an area where traders might look to either add to a winning trade or maybe start a new winning trade if you believe that this is going to continue. I'll admit, it is getting a little long in the tooth from a rise or riding a 20-day moving average. It's one thing to ride a 50-day moving average for an extended period of time, but the 20-day being so short run, commonly we see that get into the 12-week window and it starts to get a little bit tired. But, you know, in this case, we may see this continue because the reminder from the macro side of things is that even if we get a resolution to our conflict in Iran, this has been a macro shock to the system. And so that is a heads up. Even though we can see lower barrel short run, the opportunity to get things back flowing the way that they were prior to the events, then we have a bit of an issue, right? It's not likely to clean up, so to speak, immediately or quickly. It's something that takes months to clean up and get back to some semblance of normalcy. So don't anticipate necessarily that even the conclusion of a conflict is going to lead to immediately lower barrels of oil on a price basis. That's kind of not as likely as much as we would like it to be. Let's move on. So there's your energy. Materials are getting a bounce. And yeah, maybe a bounce from an area that looks like support. How about that? Prior highs. So we just talked about the transports, breakout and throwback. Same thing here in materials. Industrials possibly holding up, but notice that 20-day crossing the 50 to the downside. So our short to intermediate term trend is a little under stress, and a rally into this bubble that I've just placed on here could easily act as resistance. So be prepared for that. Always define how we're processing this, right? Are we buyers because we think we've got a relief bounce, in which case we're sellers at resistance, or are we buyers because we expect a reversal or a continuation move in the broader, in this case, the sector? If you're expecting a continuation move, you probably didn't take a full position size here because we still have so much overhanging resistance, right? Some traders would just say, hey, I think it's going higher. I'd like to be a buyer down here. But if I'm not trading it for the speedy move, bounce off support into resistance, well, then the trader might go with a little bit smaller sized thought process there. Let's see. We said discretionary was leading us today. Yeah, it's up. But this is not a bullish look of things. We made that recent low kind of the best case scenario from standpoint here is that this is a flush out of the selling. And if that's the case, great. But we're going to have to get above the 20-day to start feeling like that has any opportunity to be the case. So everything kind of taking an initial pop to the upside and breathing here. That's not terrible. I'll remind you, the first 30 minutes, the first hour of the day is going to be more volatile. That doesn't mean that we can't take something from it. It is good that we're up to start. The fact that we have, even though we've sold down from the highs, the fact that we've remained positive on the day is still okay. Know your levels, everybody. Again, know where you want to take action. Know where something maybe changes for you. Let's take a look at staples here. That's a pretty interesting spot once more. Back to horizontal support, 200-day moving average beneath us. It is into oversold conditions down here with the RSI. So make note of that. But staples, not really in a leadership position all of a sudden, is it? I mean, they made a huge move to the upside here. Let me put a line on that. Let's define that rally because that was an incredible pop. Staples added 18%. Goodness gracious. And then promptly gave back most of it. Their big sell down gave up about 9.5. I guess only 50% of it. That's notable itself, right? Big move to the upside, give back half, see if you can hold support, not uncommon. So Staples look like it could be at a zone of potential support here. And then let's see, oh, gosh darn it, one of our worst performers, financials rallying into the 20-day. We know the story here, right? Are we getting above the 20-day? I mean, everything we talk about in this class or in this review of the broad markets, look at the 20. My goodness. So we're at resistance here in financials. Can financials pop through here? Dubious to that extent because we've been beneath it for what is now, what, 2.5 months? So that's, again, getting a little long in the tooth to manage a trend against a 20-day. So maybe we are nearing a spot where we can get a bit of a bounce in here. Just haven't seen it play out in the financials just yet. All right, let us do one more. Okay, let's do tech. Let's just see, because we are up here, but look at this, everybody. I mean, I think this is more about the 50-day. I've been mentioning the 50-day with the NASDAQ 100. And right now, it looks like the best thing we could say about the technicals on technology is that we've got, if I take this line, because we made a lower high in price this last few days, so you've got this gentle downslope to these lower lows, and we've got the 50-day moving average hanging over us, downward sloping here. The best thing we can say is that we've got a bullish divergence, right? We've made a lower low in price, a higher low in the RSI. So we would call that a relative higher low and or a bullish divergence. It doesn't mean anything other than we might look at this level as being available to hold. So some traders would feel a little confident about this. They might say, all right, with a bullish divergence in technology, I could possibly establish a position and have the confidence to say that if it made a new low, you absolutely should be moving on, right? That's what a trader would really think is, hey, we've made a low, we've got a bullish divergence, that low should hold. Therefore, I'm going to be more confident in taking a position. Nonetheless, a price trade below that level that we've just made, the low, if we make a new low, hey, that's the continuation trend you don't want to be in if you're bullish, right? So ultimately, this has the makeup of a visually a little bit of a slow bleed in technology. So it's as of now, quite unclear as to what is going to happen here with technology, but we'll keep watching it here, everybody. Oh, I'm glad you asked that, user. The bottom line there, I use DMA to define my moving averages because that's the daily moving average. So on my chart here, the 10 DMA is the 10-day moving average. It's just the same, essentially. But remember, your definition of your moving average is defined by the type of chart you're looking at. So if it's a weekly chart, then your moving average is a WMA. So a 50-week moving average or a 200-week moving average, or on an intra-period chart, it could be an hourly moving average, right? So we always reference them as best we can as the period moving average. Okay, I wanted to make sure we got to some upgrade details, everybody. I had a few positions that I thought were notable, some names you're probably familiar with. I wanted to drop in ARM here. ARM is the symbol. In our final couple of minutes, we'll get to a few of these individual positions. Raymond James, as you can see, got a nice bump today, 16.5% on ARM holdings here. The Raymond James upgraded ARM to outperform, had been at market perform, new price target of 166. Of course, every price target is just that. It's a target, by no means a guarantee to be achieved. Raymond James citing the company's announced business model shift to include a fabless semiconductor element for their upgrade. ARM has increased its forecast, calling for a 2028 earnings of $3 per share. but in 2031, excuse me, fiscal 2031, that's being about 3 years later, looking at $9 a share. That'd be a 200% bump, everybody, in terms of the fiscal expectations on a per share basis. So 2028, Raymond James looking at $3 a share, but by 2031, reaching $9 a share. So that would be an industry leading viewpoint according to Raymond James. So that's why for the upgrade, everybody, and you can see a pretty good gap move through the high we had been on here. That was a pretty significant development. Let me just see if there's anything on the weekly, and boy, that's really tough, right? Because the range on the weekly is pretty wide. Basically what? The most recent low in the neighborhood of 80 and the most recent highs in the neighborhood of 180. So that's definitely tricky, and there's not a lot of pattern to work with here. So if you're basing it on recent trend, it could be possibly just as simple as watching the gap low. We know the importance and significance of gaps. Okay, next up, from an upgrade standpoint, how about General Motors? GM got upgraded. Let me put all my moving averages back in here. GM got upgraded at Wolfe Research to outperform from peer perform. Price target at $96 on that one. Was looking for something a little bit more specific here, but I don't really have it on GM. So I wanted to just point out, if nothing else, one thing of an area of support. Bullish trend traders like being above the 20-day, but we've still got a former support zone here of horizontal price levels being maintained. Happens to be coincident with the downsloping 50-day. That could be resistant for GM here as well. Another one that got the upgrade is in the energy space. It's ONEOK. OAE. I'm going to bring that one in. And this is one I had actually reviewed and discussed in the last few months on my building a stock portfolio class. ONEOK was upgraded at Wells Fargo. And of course, as an energy stock, we probably aren't shocked to see that it's in a bit of an uptrend. They were upgraded to overweight from equal weight with a price target at $100 that's been lifted from formerly 81. The firm says the Iran war will create a structural shift in global energy markets, including the midstream. The war will boost demand for U.S. energy, according to analysts. Wells expects the Permian gas and natural gas liquid supply to accelerate in order to meet this growing demand. And so Wells Fargo has upgraded ONEOK as a result. Now, what I find interesting is not just the uptrend and the 20-day moving average, but we got to make note of this. I just got done talking about the importance of gaps. We've made a move through a gap zone that, always go a little bit more left to confirm to the right, correct? And here we've maybe established a new foothold. Let's not get too far ahead of ourselves. We have broken the downtrend here, or this little consolidation, I should say. This kind of looks like exactly what you'd expect after getting over the downtrend line, a little bit of a push higher. But, some traders will look at this breakout level as needing to hold right around 89. But for a lot more traders, perhaps, it might be the 20-day. So risk management could be the 20-day on the trend line there. That could work out for some traders. We'll see how this continues. But if nothing else, the story, as is relative to energy broadly, is apt to stay positive for energy stocks as well. So, this was an interesting note to me. And then last one to look at, and this is where we're going to wrap up, is Amazon. And really, it's in the news because there's some increased price targets on Amazon. Citi raised the price target on Amazon to $285 from $265, maintaining a buy rating. JP Morgan raising the price target to $280 from $265, maintains an overweight rating as well. And, we've been watching this as one of the bigger positions, but a lot of those so-called Mag 7s have struggled, but ultimately maintained the majority of their uptrends, taking these lines that I had drawn in off. And if we're just watching the trend, hey, let's just look at this from the standpoint of my 100-week moving average there in gray. I'm going to hide the 40-week. Look, it was resistance until it wasn't, right? Got above it, and then it became support. And then we've rallied, and then we came back for a test, and it was support. And now it is potentially support. A lot of longer term traders would look at this area as a potential spot to expose money. And there's nothing wrong with doing so. We obviously recognize that there's always the risk that the stock could go lower. So even a long-term investor who wants to put some money into work here could choose to do so, but maybe not every working dollar, right? Just some that they were looking to expose to Amazon if they were trying to be patient. But everything that's been going on here, even though it doesn't feel fantastic, Amazon's been above that 100-week moving average since the summer of 23. So you're looking at nearly a 3-year-long trend, and we are basically sitting at an area of potential support. So let's see if it plays that way. Yeah, could be a bear flag as well, Rita. That's entirely possible. It certainly looks like it could present that way. But you know what? Bear flags in uptrends are a little different than bear flags in downtrends, much like bull flags in an uptrend are vastly different than bull flags in a downtrend. Maybe we'll talk about that. I've got the upcoming class here real soon for trading price patterns. So we'll check that out a little later. So let's wrap it there, everybody. Thanks for being here today. Always appreciate your comments and your questions. Thanks to Barb Armstrong in the chat. Follow us on X, Barb Armstrong CS, Kevin Horner CS. If you liked the discussion, it was helpful for you, hit that thumbs up button for me today. Always appreciate that. Hope you all have a great rest of your Wednesday. Again, I'll be back a little bit later. So check the calendar for more from us. A full day of live content here on the Trader Talks channel. Have a great day, everybody. I look forward to seeing you again real soon.